Warren Buffett started countdown for the crisis. Tech stocks will crash if this one thing happens. Warren Buffett talks about what could cause tech stocks to crash. He also discusses what tech stocks to buy if you believe interest rates will remain low. Buffett says that he doesn't think valuations for tech stocks are crazy if interest rates remain low. However, if interest rates rise, Buffett says that could result in a sharp decline in the price of tech stocks trading at high PE ratios. Today we're going to talk all about Warren Buffett's warning about the tech stocks and their upcoming crash. So watch the video till the end because today's video is going to be the bomb. Welcome to Investor Secret, your daily dose of wealth secrets. If you're interested in everything around big investors and their investment techniques, this is the place for you. Subscribe if you want to stay updated with all the investor secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. For investors who have profited mightily during the crazy pandemic bull market, anything that isn't a high-growth, supercharged, change-the-world tech stock can be a hard sell. Tesla is the future, as many Tesla shareholders will tell you, so why would old-school consumer staple stocks or energy plays merit any interest? But as we head towards 2022, those investors might want to expand their focus. Right now, a host of economic factors are making cheap, overlooked value stocks look ripe for a takeoff, and the ever-stronger possibility of higher inflation over the next couple of years will only add more fuel to the comeback. We think that any way you look at it, value stocks have the advantage versus the overall market in growth stocks, says John Thorndike, co-head of asset allocation at FundTitan GMO. That's within sectors, across sectors, large cap or small cap. And if high inflation persists, Thorndike adds, value stocks will get a double boost. That's because the cyclical industries that are the bulwark of value, including financials, energy, materials, housing, and robust consumer brands, pack strong pricing power at a time when a growing economy means strong customer demand and higher costs. These value stocks are unique in providing protection against inflation, concludes Vitaly Kalesnik, a partner at Research Affiliates, RA, an esteemed investment strategy firm that sees a big rebound on the horizon for value. If the value bulls are proven correct, it would mark a sea change. Such market sages as Warren Buffett and his mentor, Benjamin Graham, secured their positions in the investment pantheon by betting that value stocks, cheap in relation to their earnings and assets, will beat the pricey, glamorous growth players over time. And academic studies confirm that during long periods, value indeed outperforms by a wide margin. But the experience of the past 15 years, and especially the fabulous performance of the tech sprinters, appears to turn that conviction on its head. In recent years, the champs haven't been automakers, energy names, and brick-and-mortar retailers, but the Googles and Amazons and Nvidias and Teslas, which have most recently mined the pandemic to deliver some of the best short-term returns in the history of equity markets. But growing numbers of investors think we may be about to witness the revenge of the dogs. Part of that analysis comes down to a belief that markets are due for a so-called reversion to the mean. In a recent study, Did I Miss the Value Turn?, Kalesnik and two colleagues from RA, which fashions investment strategies for $171 billion in mutual funds and ETFs, crunched decades of data. They found that because growth has been thumping value for so long, value stocks are now even cheaper relative to growth stocks than they were at the peak of the tech bubble 2 decades ago. Value went on to outperform growth for 6 straight years after the dot-com implosion. The RA paper argues that investors who bet on a similar pivot today will pocket market-beating returns over the next decade. That matters a lot because some of the market's current high flyers are likely to level off or tumble, and inflation is a big reason why. Warren Buffett's deputy Charlie Munger has said markets are even crazier right now than they were during the dot-com bubble. Munger blasted cryptocurrencies and said those who invest in them are just thinking about themselves, according to the Australian Financial Review. He also labeled U.S. millennials as self-centered. The 97-year-old has been Buffett's closest confidant for decades and is vice chairman of the sprawling Berkshire Hathaway conglomerate. He has a net worth of $2.2 billion according to Forbes. The dot-com boom was crazier on the valuations even than we have now. But overall, I consider this era even crazier than the dot-com era, he said in a Friday interview at the Sohn Hearts and Minds Investment Conference in Australia. You have to pay a great deal for good companies, and that reduces your future returns. The dot-com boom was a period of breakneck growth in technology stocks. Investors poured money into companies with little in the way of revenue or profits, as excitement built up around the potential of the internet. It ended in a huge stock market crash in 2000, with the Nasdaq falling as much as 9% in one day and 25% in a week. Many investors have compared the current stock market to the dot-com bubble, pointing to companies such as Rivian. The electric vehicle startup is yet to deliver meaningful revenue, but still went public last month. It is now worth $95 billion, making it the world's sixth biggest car maker by market capitalization. Munger said China, which is cracking down on debt in the economy, was right to step hard on booms and to not let them go too far. The Berkshire executive is a long-running critic of cryptocurrencies and told the conference that he wished digital assets had never been invented. The Chinese made the correct decision, which is to just simply ban them, he said. Believe me, the people who are getting into cryptocurrencies are not thinking about the customer, they're thinking about themselves. Just look at them. I wouldn't want any one of them to marry into my family. Munger said US millennials are very peculiar, very self-centered, and very leftist. His comments came a month after Berkshire Hathaway's latest earnings revealed its cash pile hit a new high of $149.2 billion in the third quarter. Munger said at the conference that sky-high stock prices meant finding good companies to buy was difficult. You want companies that have high earnings on capital and have a durable competitive advantage. And if you can add to that they've got a good management instead of a bad one, that's a big plus too, he said according to the AFR. But what you'll find is that the great companies of the world have been discovered. They're very expensive to buy. That's all for today. In the end, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. Well, that's it for today's video, guys, and make sure to subscribe and give us a thumbs up. See you next time on Investor Secret. Bye!